I mean, take a look at the employment situation. Um, and here's a case where bad news might be good news because the Fed has been wanting to cool down inflation. And part of that is the runaway wages, right? And so, first thing you notice when you like take a look at this is that the number of jobs that were added were way below expectations. And they went back and they revised the September numbers down from what they initially reported. You'll also notice that the unemployment rate started to tick up. You'll notice that private payrolls also were less than what they expected, and they went back and they revised the September numbers down there. You can see that manufacturing is losing more jobs. They expected manufacturing to lose some jobs, but lost more jobs than expected. Revise that number down. Participation rate is something I look at, and thankfully that hasn't ticked down too much. That's, how many people are still in the employment workforce here in the States. And so, that number, it's been record lows. We're starting to see people come back into the workforce, but you never really want to have a lot of your population not working. And then over here, the average hourly earnings. This is really the meat and the bones. It's down to 0.2%. If you multiply that by 12 months, that's 2.4%. That's right in the realm of what the Fed is looking for. So the fact that hourly earnings are not going up more than about 2% a year right now, based on this monthly number, that's fantastic. So the employment report, although it's kind of bad news, it's saying that things are kind of cooling down. That's exactly what the Fed has been wanting it to do. And so it all comes back to sentiment that, the Fed may be done. I mean, this is what a lot of investors would like to believe, that the Fed is actually done raising rates.